Welcome to UrbanHood, your learning platform. Urban Food Alliance is a 501c nonprofit which reaches out to the needy and the homeless who need warm, fresh cooked, nutritional meals. Urban Food Alliance services the needy in our neighborhoods.
So basically, monthly, quarterly dividends, income in different ways, and also the power of compounding your investments. So we're going to get into that as well. And this is basically just what we're trying to do is basically set up a consistent revenue stream of income where you invest X amount of dollars and you get that dividend coming in on a quarterly basis and it multiplies. So that's what we're going to get into. Again, here's our disclaimer. I don't know, Mushi, if you shared this earlier or not. But just disclaimer again that we're not financial advisors. This is just educational purposes.
Yeah, we have done that. We can skip that. Move forward.
Right. So REITs, what they stand for, Real Estate Investment Trust. Buying REITs means buying a part of a diversified real estate portfolio. REITs are legally required to pay out 90% of their income to shareholders. So that's us. When we buy the stock, we get those dividends, and that's what's passed on to us. And it is traded just like a stock. So a ticker that we're going to share with you is something you can buy and it's very liquid. So if you did have $100,000 to invest and you bought a property, it takes time to sell that. But with Real Estate Investment Trust, you're getting an asset that you can liquidate tomorrow if you need the funds. So what is real estate investing? Again, real estate investing equals profitable REITs equals dividends. That's what you will earn as far as dividends. So here's a quick takeaway from our REITs here as far as what they are built up. Real Estate Investment Trust is a company that owns, operates, or finances income-producing properties. So this could be in shopping centers, it could be retail malls, could be office buildings, industrial buildings. We're primarily focusing on more solid companies, going to stay away from the retail sector and office buildings because of the current COVID situation. Otherwise, those do also produce good income as well. REITs generate a steady income stream for investors, but offer little in the way of capital appreciation. So what that means is when you buy a REIT, the stock doesn't move a whole lot. Unless there's something like the COVID pandemic that we had, then obviously everything tanked. But otherwise, they're very stable companies. Their price remains very stable. If you look year after year, it stays in that range and doesn't move a whole lot. So that's what it means as far as capital appreciation. Most REITs are publicly traded like stocks, which makes them highly liquid, unlike physical real estate investment. We just touched on that one earlier as well. Real estate investment is most in real estate properties, including apartment buildings, cell towers, data centers, hotels, medical facilities, office, retail centers, and industrial warehouses. So these are different sectors that different REITs focus on. Also, we're going to talk about diversification. So not only are we going to talk about REITs that we give as dividends, but also diversify your portfolio into different sectors where you can basically get the best of two worlds. One would be the dividend, also the capital appreciation. So certain stocks, for example, everyone loves Apple, right? Apple doesn't pay a huge dividend, it's like 1%, but you get the appreciation of the stock as it goes up, but you also get a dividend on a quarterly basis. So that's what we're talking about as far as diversification. There's three types of REITs. Equity REITs are equity REITs which own and manage income-producing real estate. Revenues are generated primarily through rents, not by reselling property. So basically, they buy an apartment building and collect those rents, and those, or industrial buildings or shopping malls, and that's how they generate their income. Mortgage REITs, this is where they lend money to real estate owners and operate either directly through mortgages or loans or indirectly through acquisitions of mortgage-backed securities, which is another good derivative to create income. The earnings are generated primarily in a net interest margin. The spread between interest and earn on mortgage loans and the cost of funding these loans. This model makes them potentially sensitive to interest rate increases. Now, most of us own our homes. If you notice, a lot of times our mortgages are sold. And this is what means by mortgage-backed securities, where they lump our loans together and sell it to a third party. And that's where this comes in there. And then there's hybrid REITs, where they use investment strategies on both equity and mortgage REITs. Like I mentioned earlier, we're going to stay away from any REITs right now, which primarily focuses on retail investments, shopping malls, retail centers, office buildings, or hotels, because of the current COVID crisis that we have. If you have any questions, please feel free to jump in or send me a message via chat and I'll respond back. So we're looking at generating consistent income. Now you have to manage your portfolio as a business. And this is what's going to give you income. So you take your portfolio, you invest in a stock and manage it wisely. So business needs steady income, but low risk. That's what we're going to provide here. Let your hard-earned dollars do the work for you. So you invest $1,000, let that multiply and work for you. Buy stocks and reap the future benefits. And then once we'll touch base, but I just want to highlight that we're also going to talk about selling covered calls for additional income. So I'll touch that towards the end of this discussion here. And not having to monitor holdings regularly. So like I mentioned earlier, these REITs are stocks that don't move a whole lot. So you don't have to worry about if it's gone up a lot or gone down. You just buy it and forget about it. It's just going to give you that dividend every quarter. It'll be in a form of cash in your account, or I prefer DRIPS, which is basically gives you additional shares of that same stock from that dividend instead of having cash. Not having to monitor regular holdings. While most REITs distribute dividends on a quarterly basis, certain REITs do pay on a monthly, but 95% everything I know of all pay on a quarterly basis. Sometimes you also have a special dividend. If someone's made some money or somewhere or some acquisition, you may get an additional special one-time dividend. That can be an advantage for investors where the money is used for enhancing income or to reinvest, especially since frequent payments compound faster. So what we talked about as far as receiving the dividend on a quarterly basis, I recommend do not take it as cash, reinvest it into the same stock. It'll be done automatically through your broker. You don't have to do anything. So if you own 100 shares on a certain stock in 3 months from now, you will own 101, 102, 105, depending on the dividend. And every 3 months, you're getting that same dividend and it's going to multiply. That's what's called compounding. REIT investors receive value in the form of dividend income and potential share value appreciation. The second part, share appreciation, yes, but not a whole lot. Because REITs income often comes from commercial properties with long lease periods, REITs can offer relatively predictable revenue stream. That is absolutely solid. When you're dealing with commercial properties, these are people that are large buildings that lease to companies like Amazon or to Coca-Cola. And these are long leases. They sign leases on these buildings for 10 years, 15 years, 20 years, 25 years. So it's a steady income and also has capital appreciation in there as far as income because they increase it based upon the CPI index, which is usually rents go up every year by about 3%. So here's a few that we've selected here, which are REITs, and they're providing high yielding dividend stocks. So I picked a few of them that I own as well here. I've mentioned some of these before. Starwood, for example, these ticker prices are, I did this over the weekend, so the price that I've put here may have changed slightly, but Starwood, for example, is a REIT, is around $16, pays a dividend of 12%, which is fantastic, which is $1.82. So in 6 years, you'll have all your money back that you paid for that stock because your money's compounding. Starwood is a great company. Prices come down, and I think it's got the price on this one has room to appreciate. So Starwood Property Trust, they have real estate investments in Europe and USA, investing in and also servicing segment. So they servicing, which is mortgage investment servicing, and then mortgage-backed securities. NLY, sorry?
So are they a hybrid REIT then by that description?
Hybrid REIT here, for example, we're going to stay away from that. We're right now primarily focusing just on real estate. This is all real estate REITs.
But you said hybrid was what dealt with mortgages as well as properties. So you're saying they're doing servicing. So
Yep. So here we go. 1 second. So okay. See here. So you see right now we're primarily for. There are 3 sectors here. Mm-hmm. Each individual one, I have not identified each individual where it is, but most the NLY and
hey Abdul, can I jump in on this one?
Please. Yep.
Yeah. Thanks. Yeah, some of the just guys understand this. I have also a screen. I'm going to share with you little bit, and just show you how you can do a little bit more more research on your own. I'll go through this, and there you are going to find out some of these business started with, let's say, that the rental, and then they open a mortgage, and then became hybrid. They're doing on the both income side, right? So because of the economy changing, And now you see the business are adding more and more capability. At the same time, yes, and some of those REIT is taking advantage of this low rate. So when they're taking those mortgage, they are investing back to the business, right? And then they're also using some of the money as the lenders also to grow in different business areas. So I'll share with you only one Starwood. I have some screen later on, and then you're going to see. And to answer your question, Ron, yes, Starwood now they consider as a hybrid. Okay, they added some more business within their portfolio.
Yeah, there was another one that I held at one time. I think the ticker is O.
Yep.
I forget their name.
Yeah, if you know the ticker, please share on the chat line.
Okay.
Then we are going to do some more extensive research and share with you what we know.
Okay.
And then soon, based on this feedback, we might create a white paper for you guys. Okay?
Right.
Go ahead.
Okay. All right, so this is just 5 that I selected here, which I do own. I do own not PLD. I do not own at this time, or PSA, but I do have Starwood, NLY, and KREF. These are here different dividends, just to give you ideas as far as what they do. So NLY, again, very similar to Starwood, great dividend. Now NLY I've owned for maybe 20 years almost. It was used in that $10, $11 range. It fell down and it's now in the $7 range. It's been floating that $7 to $7.50 range and pays a really good dividend of 22 cents every quarter. PLD is one of the largest industrial property owner in America and also in Europe. They've got almost like 965 million square feet of real estate they own in the United States. And then they've got 5,500 tenants. Some of the tenants are FedEx, Amazon, UPS, Pepsi, Coca-Cola, Skechers, Nike, SpaceX, Tesla. If you drive around the freeway, you'll see these huge industrial buildings. That's what they invest in. They don't do malls. They don't do retail centers. It's primarily into industrial. Best appreciation they get. They just made some large acquisition last year, acquiring Liberty Properties. So again, and they're out of the East Coast, but a really solid company. The price is high. The dividend is low.
Yeah.
But you can see that there. PSA, another one there. Obviously, you know of Public Storage. And again, nationwide. And again, the dividend is really low. But the price. But again, it's a stable. So I'm saying if you diversify a little bit. And again, they're USA and Europe. And I'm sure you've seen all over across America when people need property to store something, that's where they go to. KREF is a fairly new sticker, pays a really good dividend. Again, 10% there, which is really good. Similar to NLY and TWD, mortgage-backed securities primarily is what they're doing in acquiring senior loans. So this is on the side of REITs. Now let's move on to a little bit. So these ones here are the ones that are steady. They don't move around a whole lot, but they give you a steady income, and that's what you're looking for. And if you invest this and then reinvest the dividends, that's where it's going to start compounding. So now to diversify a little bit, here's others that we've selected as far as different sectors. Their dividends are going to range in different values. You can see the price, from 3% up to 9%. Depends what they are. Again, paying quarterly dividends. And here's different sectors. So what I'm saying is basically don't do everything in financials. If you do decide to do investing into REITs or to dividend-paying stocks, diversify, healthcare, financials, energy, technology, retail. And these are pretty solid companies here that pay pretty decent dividends. And you can see I just gave you a pricing of the stock tickers that are there, what they've been paying. And you can see, and I'm sure all these names are very familiar with you. And I do own many of these here as well. And it's consistent income. But the difference with these ones here, the price of the ticker will fluctuate. So that's where you can get some capital appreciation on some of these. And when the market does go down, they will go down. I mean, take a prime example is Walgreens. It's $36. Now it's about $36, $37. It wasn't a high-fi. It was in the $60, $65 range. So that's where the dividend really comes in nice. And before it was only 2.5%. Now it's 5%. So that's where some of these tickers will give you some capital appreciation down the road. So CVS also got beaten up a little bit. VLO's got beaten up. Cisco's got beaten up. So these are some of the ones look at Coca-Cola as well. So some of these to look at as far as, I mean, and I will share this with you as well. Like it's been recorded. AT&T, 7%. I think that's a fantastic dividend. I do own that. If anyone wants to capture the dividend, it goes ex-dividend on, I believe, this Thursday. So you still have time to buy this if you want to buy it. It's in that $28, $29 range. It's going to pay you, I believe, 52 cents after it goes ex-dividend. So this is just what we meant by for diversifying to other sectors.
Are these considered REITs or are they just dividend stocks?
No, these are just dividend stocks. These are
Okay.
no, REITs are real estate investment trusts. That's only when they are real estate. These are just good paying diversifying into other sectors. So you can put, maybe 50% into REITs and 50% here. So here is where you get the capital appreciation in the value of the stock. Obviously, you get a little bit more fluctuation, but you can still buy these and forget about them and just reap the benefits of the dividends, if that's what your main goal is.
Okay.
But again, in future, I mean, obviously you were hoping that the stock price will also be appreciating as well. I mean, you still need to evaluate your portfolio if you're buying dividend stocks, I would say at least every quarter. You don't have to open every week or every day or every month, but every quarter reevaluate. You may want to reposition your portfolio. Something may have gone up a lot and you appreciate it. Well, you want to take that money out and now you're only getting, because you got invested, you're still got that percentage wise, but maybe you can find a better investment and move your money there. So, but you do need to watch your portfolio, but not very regularly. So now I want to get into compounding. So we're talking about here compounding is reinvesting your dividends. Now, if you look at the graph here, let's look at the one at the bottom, the power of dividend growth. On the bottom is that blue line. That tells you that if you do not invest any of your dividends, your money's not going anywhere. It's just your stocks basically just stayed flat. Now, look at the green one above, and that's only at a 4%. In 30 years, it's showing how it's appreciated. So this is what we're talking about as far as the dividend growth, is investing that. And the one on top is we're talking about is really the power of the compound. Look at the different percentages you'll get in far as your dividends you're receiving and over the time. And I'll show you on the next slide as far as how that compounding powers your portfolio and helps it grow. You're not going to be investing in 2%, so you're going to be investing at 4 to 10% range on average. So your portfolio in 10 years, 20 years is going to really compound. And the more you keep investing as you get additional capital, it's just going to help it grow. So here, let's go to the compounding here. So here, so when a stock pays a dividend, the stock first has to declare a dividend. So if you'll see, you'll get an alert, or if you go online, it'll tell you that so-and-so declared a dividend. That does not mean they're paying it that day. They declared it going to be paid in a future date. Then there's the X date, which I just mentioned earlier. So like AT&T has declared dividend about a month ago. So X dividend is, I believe, next Thursday. So if you buy the stock today or tomorrow, you will capture that dividend. And then the day after the X dividend, or 2 days later, you can sell that stock if you want. You will still get the dividend. Once you own the stock prior to the X date, you receive that dividend no matter what. It'll be paid to you in 30 days from now, but it'll be paid to you. And then you can see the pay date. So that's the declaration of the dividend date, ex-dividend date, data record, and pay date. So here, stock price. So when you own a stock, next day, after the ex-dividend day, the next day, the stock price will drop by the amount of the dividend. So here's an example of a stock that was $7.50 that pays 22 cents. When the next morning, when it opens up, it will be at $7.28. And that's standard with all stocks, but they come back up and as far as appreciation goes. So here's now a little small example I gave you as far as compounding. If you were to buy NLY, which is actually was about 720, bought 100 shares. And everybody's going to depend on their portfolio size, but if you can buy 100 shares, it's better, and I'll show you why towards the end. Buy 100 shares of a stock. Don't try to buy 50 of this and 50 of that. Buy 100 or set up a budget. But I usually buy in hundreds, and I have that because I do it for a reason. And I'm looking for additional income. And you can only do that if you own 100 shares. So if you bought 100 shares of NLY at $7.20, paid a quarterly dividend of 22 cents. That's $22 that you receive every quarter. And pretty consistently, that's the dividend it pays. Which means you can receive the cash of $22 or reinvest, which is called the drips, into additional stocks, which means you will have 103 shares after that dividend is paid, after pay date. And that's going to compound. So what my as far as compounding is, if you bought, just take NLY, you bought that at $720, that investment is going to grow. You can see that below there, I put down the first quarter, you have 103 shares. These are all approximate numbers, but in 12 months, if you receive quarterly dividends, that's reinvested. In 12 months, you have 110 or 112 shares. You can sell those shares if you want, but let them reinvest, and compound. And I just give you an example of 3 years. That initial investment of 100 shares can be 130 to 140 shares, or 145 in 3 years from now. So you can see the appreciation you've got by that one investment, not taking out the dividends. That's just reinvest the dividends. So that's my advice: is do not take the dividends, reinvest. Sorry, you were saying something?
Yes, Abdul, I have a newbie question here. This drip, does that, if it's not enough money to buy a whole share, does it buy partial shares, or it has to wait?
It depends. I'm not sure, Mushi, if you know, but it depends on the broker you have, maybe, or I'm not sure with all the brokers. You may get half if it's a partial. You may receive a partial, or if not, you may just receive the cash at that point. It just depends. Like, I know mine, I don't get, if it's over and above, I don't get the additional shares. It's just cash.
Who's your broker?
TD Ameritrade.
Okay, thanks.
Okay. So here's so going back from the compounding, and I talked about the 100 shares. Any questions further on far as REITs before I move on to a different sector?
No.
No. Okay. So covered calls.
I have one question.
Yes.
Going back to the screen where you had the list of REITs.
Okay.
And yeah, like that one right there. And I guess I see 3 of them are pretty, are high. They're in the 10 plus to 12% range. So I could see for diversification why you might want to, own 2 or 3 of those. I was a little less, I didn't follow why you would want to own the other 2 unless you're saying that there's more potential for capital growth with those.
Capital growth. I mean, PLD, PSA, they're capital growth. They're always expanding, reinvesting, acquiring additional real estate. So that's where a lot of the money is invested again. But again, on those ones, it's more capital growth and capital appreciation versus NLY, Starwood, CARIF. They're going to be pretty consistently staying where they are today. And a year from now, pretty consistent, that's where they will be. Not a whole lot of appreciation there.
So the other 2, you see a pretty good potential.
I mean, I know PLD very well. I know the company. I have dealings with the company. I know them very well. It's a very solid company. Very solid company.
And PSA, I guess we all know what that
Yes.
is.
Yeah. Yes. Prologis is one of the largest industrial buildings owners, and their tenants are all Fortune 500 companies, and I mean, very solid company. And they basically buy just large industrial buildings. That's it. Industrial buildings have a very high appreciation as far as asset goes, and they usually turn those over after 7 years. They don't hold on to that asset. They basically put a portfolio of 50 properties and they sell them over again. They take the appreciation of the property they bought, the price has gone up, they'll sell it after 7 because they've got income and they've appreciated in value. And they'll move to a different sector or different areas in the country. For example, like here in California where I'm at, would sell a portfolio of 50 properties in a certain area where it's really gone up in value and move to an area where it's still developing. So they'll buy those properties at a lower price, get the income, and 7 years they've appreciated and they'll sell that again. So that's Prologis. Any other questions? Okay, so covered calls. So why I buy 100?
So Abdul, any idea on the well WLL.
I don't know well. I will take a look at it for you. If you can put it as WLL, you said?
Yes, yeah.
It's a petroleum company.
Hey, Abdul, just
No, WE.
Abdul, just for now, just keep that,
Yep.
guys. As we said, please put the sticker on the chat
Chat
line.
box.
We'll see if we can go through it.
Okay.
But for now, let him finish the content, and then after that, I'm going to share with you also how you do some of the research. And then, as we said, this is not our last. We are going to do more follow-up. So ask any questions, also our topic that you'd like us to cover in future. So we will add those content and we'll do the same REIT. I see that a lot of people have interest on this one, and some people are already private texted that they missed out. So we'll definitely do more often this topic. Okay.
All right. So covered calls. Why I buy 100 shares? I love extra income, and I always buy every stock I own today. Everything on all of them, including Tesla, I have sold covered calls on. I don't mind if the stock appreciates and gets pulled away, but I'm really doing it because I know that a lot of times I sell at a certain strike and the stock doesn't get there. So it's a basic strategy. Anyone in any portfolio, you don't have to be approved to sell covered calls. So all basic accounts can sell covered calls. And why sell covered calls? Additional income. So I'll get to that example here. When you own shares, you have to own 100 shares. And you are the seller of the option. As seller, we collect a premium paid immediately into our account, and it's ours to keep. No one takes it away from us. It's ours. It's cash in your account immediately. Requirements. What does it take to sell a covered call? You have to own 100 shares of that particular ticker. If you own 105, no problem. You only sell 100 shares. You have to have 100 block of 100 because option contract works in blocks of one option contract is equivalent to 100 shares. So when you sell a contract, you're selling one contract against 100 shares. And what is a covered call? Let me give you an example here. So now XYZ stock is trading at $52. We're going to sell a $55 call option a month out, so into October or November. And for that, we receive $3. So immediately we'll receive $300 in our account. If the stock appreciates and gets to $55, we are obligated to sell that stock at $55. But that's okay because we sold it for $58 because we received the $3. If the stock remains below $55, you get to keep that $3 or $300. You get to keep it. So you see the difference? And today was a great example. Today market went down. I was happy in some respect because I had a lot of covered calls. I'm going to buy them back or I'm going to let them expire because the stock's not going to get to the price I sold the options on. I mean, take American Airlines. Stock went from $13 some down to $12 some. I'd sold some $15 calls into next week and the week after. Stocks, that value has just dropped by 50% today. So it's hard for it to get back up there. So this is the benefit of this is even on your REIT stocks, all these, they don't pay a whole lot of dividend, a whole lot of premium, but you can get that income. Why not sell it? And the further you go out, the more premium you're going to receive. So instead of going 30 days out, you can go 60 days out or 45 days out. If you do not want to sell that stock, pick a higher price of a strike. You'll get less money, but that stock will not be called away. I honestly have no problem if a stock gets called away because I'm not married to any stock. If I sold it for a certain certain premium, and if that strike gets pulled away, that's okay because I got the stock price I wanted plus the premium on top of it. See, some people get scared. Like this last week, I got people call me and say, "Hey, I sold a stock, BA, for example, Boeing shot up pretty high, and got worried. Hey, I don't want to lose a stock." Well, why do you sell a sticker? That's a strike price. You should be happy the stock's gone, but it won't get called away immediately. It's more towards expiration, and sometimes it will not get called away. So it just really depends on the exercising of the buyer that exercises that. So this is what covered calls are. Any questions on the covered calls? Okay. So I did a little bit of pros and cons on far as, yes. Pros and cons of selling covered calls. The seller receives, so the pro of selling covered calls for income, I do it for income basis. And the seller receives a premium for writing the covered call immediately on the date you do the transaction, like I just explained to you earlier, that you receive it right away. So if you own the 100 shares, you sell the covered call, that's on top of the price. So you sold a 55, you're actually getting $58 for that call. If the price of the stock is a 55 with option expiration, call will be exercised. At this point, the 100 shares, you will be sold and the money will be paid into your account for those at $55. You receive that money of $5,500 into your account right away. $300 received for selling the option plus the $300 capital appreciation on 100 shares. So you got a total profit of $600. If you bought the stock for $52, you sold the $55 strike and the $3 premium, that's pretty good money. The premium received can help offset downward movement. And this is what I'm talking about for us today. What happened? The market moved down. So market moved down, this gives it protection because now the premium you received, it's yours to keep, and the stock doesn't get there, it's yours. So now you just lowered your cost basis, especially with some high-flying stocks. I mean, it really comes in handy. In this example, the investor purchased the shares of 52. If the stock would trade at 49 at expiration, the investor decided to sell his shares at profit would be zero. The $3 loss on the shares is offset by the premium received. So if your stock went down to $49, you didn't lose because you got the $3 premium today. So that's where it offsets your cost basis. I mean, I have got some stocks. I've been selling calls on them for years. I mean, I just keep selling them. And they don't get called because I go up a little bit high and I just want to keep that income coming in. But what's the cons of selling a covered call? If the strike price is well above the, if the stock price is well above the strike price, the seller does not enjoy the full appreciation. That's what we're talking about for as appreciation. So if the stock, in this case, went to $60, you're obligated to sell the stock at 55. You have to sell it unless you buy the call back. So that's the only downfall. But I don't see the downfall. I see it as a profit. I've just locked in my profit and I know what I'm going to get. The seller's profit is limited to the premium received plus the difference between the stock purchase price and the option strike price. The option seller cannot sell the underlying stock without buying the call option back. So like I said, once you sell the call, you're obligated to sell the stock at that price unless you buy the call option back. At a significant drop in the price, if the stock is greater than the premium, will result in a loss to the entire transaction. So I don't recommend buying the call back, even if the stock has gone up. Let it go and let it be exercised. You've made your profit. You can always buy the stock again. Premium amounts are based on historical volatility of the underlying stocks. Stocks with higher option premium will have a greater risk of price fluctuation. So that gives, for example, like Tesla fluctuates a lot. On that one, the premiums are high. I mean, I got some really good premiums on my Tesla stock, but on my other stock, like for example, on AT&T, it doesn't pay a whole lot. So it gives you, because it's more of a stable stock. So the volatility is not there. Losses due to downward moves in underlying stock price only limited by the amount of premium received. So if you receive the stock prices drops, you receive premium. It's limiting your downside as far as where your losses are. Like if it did drop down to $49, you've got a $3 premium that you received to bring your cost basis down again. As you can see, selling covered calls for income offers both advantages and disadvantages to outright stock ownership. They can be great tools to generate additional income for an equity portfolio. Strategies using options to generate income can be simple as selling covered calls. No risk, just limits your upside potential. Like I mentioned, every single stock I own, I have sold covered calls on everything. I just like to have that income. I highly recommend that. It just gives you, and it also gives me cushion. If the stock price drops, and I'll take example of Tesla because it came down quite a bit this week. I had sold some calls in the 475 range. I know the stock, I didn't feel the stock's going to get to 475, so I sold 475 calls. I'm going to get that premium, keep it. I received like $25 for that premium. So my cost basis for that stock just went down by $25. So that's why I really highly recommend that buy 100 shares and sell the covered call. You will enjoy the benefits of it. That's all I've got for today. I'll let Mushi share his share of his screen. And then if you have any questions or anything in the chat, I'll take a look at that and try to help out.
Thank you, Abdul. If you can stop sharing and let me just share my desktop. Okay. Oh no, I guess what happened? Okay, Abdul, you can share your video. I think by mistake I just All right,
Okay.
guys. One of the thing I think I'm going to share with you that how can you do some of this research? I know we do this during the weekdays many times, and we shared. But before I go further, I do wanna just share with you guys this link. You can see my desktop, right?
Yes.
Okay, cool. First, I know not everybody is going to be here, but one of the thing, if you go to our website, those who is new, you can go urbanhood.org website. At the upper right, upper left, you'll see a lot of link, especially the YouTube channel. We have a lot of videos on the YouTube channel. Those are all free videos. You can go there and watch those videos. That's going to help you to understand some of the concept I'm going to share right now. And on the upper right side that we have live the chat, we have that Telegram and Discord. Telegram is very quiet, especially during the market hours. We don't chat much on Telegram. Our main chat platform is Discord. This is just like another app, all right, on this side. But when you come to the website, you'll see in the middle the thing that what I just mentioned, that those in I'm going to share with you a coupon or something here. If you come on the middle, you are going to see you have a link to donate any amount to our charity. You'll get an email just with a 20% off coupon to use it for a new membership, or you can sign up for any classes that we offer. We have many classes. So as you can see that we are a non-profit organization, we use the money to support our cause. So you'll get it. So we are running UrbanHood, the Prime deal, just like you guys going to see in the Amazon is going to be Prime Week is going to be start doing next week, Black Friday, and a lot of companies are doing. We are also kind of offering the same thing to our members. So when you go on the website, you just decide. But one thing I want to make sure that you guys know that that 20% coupon is going to be used on one class, or it can be that's not monthly membership. Either one of the thing we added to 3 month quarterly membership or the yearly membership, whichever you go, you'll see that there is already a discount. You're going to get another 20% on top of it. And some of you might be saying, hey, what happened to me? I was already signed up. But you guys already know that you guys are way more generous. We are doing this to support the cause. Okay. So once you go there and you'll get that email with the coupon code, and then I'll share at the end. I'm going to those who donates on the side. You can go this way, get any amount. You can get it. Now how do you do this kind of research? Morningstar, when you become a member, that we have access to this the paid services, or you can go buy on your own. You can see that these services, some of them are start with the free, but as you try to get more involved and more research, then it's not free anymore. For example, Morningstar offer you a free account, but certain information they are not going to offer you free. Like for example, let's when Abdul mentioned Starwood, STWD. I entered Starwood, and you can kind of get this information, but this is only for paid members for Morningstar. But look at this, the key things here is that Starwood is undervalued, 24% discount. So currently, a lot of stock is so high, but this stock is 24% discounted price comparing last year. So this is really good that you can consider that, hey, this what is recommended price. They also give you some of the recommended price. Fair value of this stock is around today is 20. But if you can get less than $10, the best price you can 5-star price you can get it, right? But did it happen? We'll go together and see it. The other thing what people are saying, what does this company do? Here, that these research already done by their analyst. You can see that all the mortgage, first mortgage income, primary market, they are in different sector. So it's not only just rental. You see that here is a sector, industry, REIT, mortgage, and then they have rental, and that when they started and where are they located, how many employees they have. So good amount of information sitting there. The other thing also as an investor that you want to look into the ownership, just like in what percent of what the people own it, what that track record, some information they share it here. that you can look into that go through it. So one of the things is you see that who are the people, big people. Vanguard is has this. Vanguard is already very well reputed company. They have their money on it. Look at Vanguard. How many Vanguard has money invested in this? Fidelity invested in this, right? And then and the other Fidelity, Vanguard, so that kind of gives you right away credibility is a good stock that big amount of some of the credible companies are investing in this ticker what he shared and operating performance. So one of the things that you want to take a look at it when you invest. Actually, let's see this. What do they have? Yes, as an investor, especially REIT, you might want to look into this number, return on equity. Return on equity. This is the one of the key number that we finance and we try to look into. Look at this. That from age 2014 they had a 12%. Is very good. At the end of the day, that it's a typical real return of investment. And you get even S&P around 6%, 7%, no more than that. But here you not only get dividends on here, your return of on equity is 12%, 11%. 2016 is going down, a little bit down. 2018 went down, but look, 2019 is going higher, right? And then 2020 is running. So that kind of gives you an idea. It's a good. They are what Abdul says. It's a good company. It's a credible, and there are more you can look into it. So the other thing what I wanted to show you, this is what I'm using. This is TD Think or Swim the platform. You can download it. You can also do on the web. It doesn't matter which, or if somebody has other tools, you can use it. Everything is pretty much gives you the similar information. So you see that here I'm going. I posted in a Starwood at the top. I'm looking at the day chart. Is a day chart for 1 year. So a year ahead. Look at here. Look at keep my mouse. See that what happened around May. It was at May time, it was around $10, $11. See, it was almost close to that Morningstar 5-star price that what they are talking about. But look at the May. Since May, it started, May, June, it started going up, going up, going up. And at some point, it went to $18. You see that it went up, 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 up. The stock is like in a web, up, above. It went all the way to June, that's $18. But then it pulled back, came down, came down, came down, came down. Here again going up, down, up, right? You see that whole time it looks like it stayed around $16 range to like this range. It's $16 to $13 range. It stayed most of the time. Remember, I'm looking at them till May. Now let's try to go back a little bit earlier. Look at this stock. It was not too long ago. Last year, November, December, it was around $24 range. You see the $23, $24 at that range stock. So that kind of gives you that stock what you just saw Morningstar to show that so there's a discounted. At least now with your eye that you can say that it's a good stock, good companies are already invested in there, and hence, like the stock is already sold time sitting around here. Can it go up? Of course, it can go up in any time. We do not know. But again, there are other variables also involved. You guys already know what we're dealing with. Pandemic, we're dealing with the sector that's already got heavy heat. And can it go down more? You never know. It can go down more, right? But those are the research that you can do on your own when you feel comfortable. You can stop thinking about, I'm going to invest. And then when you join with us during the midday and every day and Monday till Thursday, we do this kind of thing with the paid members. On the website, you're going to see the different tier of membership. We have silver, gold, platinum. So one of the things we have done for this prime time that we added the quarterly. A lot of people requested if we can, instead of having month and 1 year before, we added 3 months. So you do not have to go every month to add yourself, be a member. You can sign up for 3 months membership you get that 20% discount, as I mentioned. You can get that. And then that 20% discount going to work 3 months or the 1 year, either one. Okay. I think that's what I have. At least I wanted to share with you that when you do your research, that this is how the different tools, paid tools or unpaid tools you can use. But being a member with us, we do that research for you. We share with you that what we find. At the same time, we are also in it with you. Like this one that the amount of research Abdul has done and others also have done. The only thing that we all going to take advantage of it. Yeah, there are some tickets that it caught my attention. I'm going to spend some time and then I'm going to get in some of those investment. And then together we make money. Together we also help each other.
Thanks for watching. Visit our website, urbanhood.org, and join our community at meetup.com and look for financial freedom for you. Thank you, and we hope to see you soon.